Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everyone, and welcome to this Wednesday, December 13th edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for another trading day ahead. Well, day two of the Fed meeting. We're going to get an announcement later today at 2 p.m., most likely suggesting that the Fed is going to hold rates steady. No hike, no decrease, just going to leave them alone. But the big question is going to be, what does the Fed say? Does the Fed acknowledge that everything is working and that inflation is coming down? It certainly seems that way. We got another inflation report this morning. It was the November PPI, and the headline number was expected to come in at 0.1% rise. Instead, it was flat. The core PPI was expected to come in at 0.2% rise, and it too was flat. So again, we had a pretty good report yesterday on the CPI, especially at the core level. Nothing unexpected. And then today we get the core PPI below expectations, and we got the Fed churning on all this economic data. And in about 5 hours or so, we'll be out with not only their decision, which I think is a foregone conclusion at this point that they're not going to do anything, but they'll also be out with their new wording and what they are seeing, what they expect to see. Will they finally say, hey, we're winning the war? I doubt it. I think instead they're going to say we're going to remain cautious. We're going to keep looking at the data, and we may not be done raising rates. We don't know. That's what I expect to hear. Anything better than that, we could really see a melt up. The market's been extremely bullish here, really over the past 6-7 weeks, since that the late October low, right on cue with historical patterns, by the way. Not normally, but historically, the best time of the year to be in U.S. stocks is from the close on October 27th through the close on January 18th. I said it at the time. Technically, things didn't look very good at that time, but we saw some technical repair very quickly once this historical bullish period hit. And the rally started right at the opening bell on October 28th and hasn't really let up since. So things following historical patterns for sure, except this week is supposed to be a little bit of a down week, and we see the market continuing to push forward. We have futures up a little bit. I believe all the major indices are up somewhere between about 0.1% and about 0.3%. I think the QQQ was doing the best this morning. It's actually up almost 0.4% right now. The QQQ trading over 400.17 this morning, closing yesterday at 398.67. So that strength just continues and continues to move higher. Let's go ahead and take a look. Hold on a second. I got to get your screen up. We're going to take a look at the action from yesterday. So let's go ahead and do that now. We've got the Dow Jones Industrial Average up almost 0.5% yesterday, roughly 0.5%. S&P 500 just slightly beneath the Dow, rising 0.46%. The NASDAQ 100 up more than 0.8%. Mid caps down 0.2%. Small caps down 0.1%. And I should say that of the major indices, the small caps actually tend to perform the worst this week, but they tend to perform the best in the second half of December. So at least that part of it, small caps have been struggling, not really going down, but just kind of treading water here at the current level. The IWM right around the 186, 187 level, closing at 187 yesterday. Transports rose 20 yesterday. That was up a little more than 0.1%. So not as good as the major indices, but also still in positive territory. So that was good. Moving on to the sectors, financials back in a leadership role. We've seen financials perform really well since about mid-November, certainly coming off of that October low. Financials, one of the areas that is leading the market to the upside. I don't think that continues longer term. I think it's probably going to be short term, and then I expect that maybe they just go along for the ride. So I don't expect the leadership to continue, say, for the next 3 or 4 months. I think it's probably a 2023 thing. and then maybe later in 2024. That's kind of what I would be thinking about. I'll be looking at all that before we do the Market Vision 2024, which is the first Saturday in January. We're going to be having a lot more information about that and how you can join us for Market Vision 2024 over the next week or so. Technology also performed really well yesterday. Technology has been the leader, really driving the market to the upside. This is the most heavily weighted sector in the S&P 500. And when technology gets on a roll, it tends to take the market with it because it does represent about 28% of the S&P 500. Energy on the other side, crude oil prices dropping back down yesterday to about $68 a barrel, maybe 68 and change. Today it's up a little over 1%, back to 69, little about 69.40 a barrel. The U.S. 10-year Treasury yield, by the way, down 4 basis points this morning on that PPI news. Trading the 10-year Treasury yield is currently sitting at 4.16%. Moving on to the industry groups, thought I would mention the commodity or chemical commodities right here breaking out. This is a part of the material group. This was a breakout, a clear breakout above a lot of overhead resistance if you go back over the last several months. So that was a very, very strong breakout. The more groups that participate in this rally make breakouts, break above moving averages, and so forth, increases the intensity of this bull market advance. So even though I don't expect materials to lead the advance, it's nice to see an industry group like this within materials making a big breakout like this. Airlines, I tell you, this has been one of the hardest groups to forecast in 2023. I thought back in the summertime they were ready, they're taking off, and next thing you know, the flight was delayed. Airlines coming back for about 3 months, and now all of a sudden taking off again. So airlines, another good day yesterday, rising over 2%, and obviously in a nice uptrend above the 20-day, which is now above the 50-day after that recent golden cross. And then finally, reinsurance stocks in the financial area. Again, the financials best area yesterday. This was one of the reasons why. Reinsurance up about 1.8% yesterday, seemingly breaking or ending now the downtrend that tested the uptrend line that's been going on for months. Now reinsurance stocks appear to be gaining some more strength again. Maybe now that they've moved back above the 20-day, maybe going back to challenge that late November high that we saw. All right, 10-year Treasury yield. So I mentioned that the PPI came in slightly better than expected. That's great news. I prefer CPI. That's the one I look at closest. I like to see what's going on at the consumer level because we've had issues with PPI in the past, but we've never felt it because the manufacturers, wholesalers, and whatever don't pass it along to the consumer. They eat it. This year has been, well, last couple of years have been a little different because we've seen inflation really perk up at the consumer level. But over the course of the last year, year and a half, that inflation rate has been going down at both the core level and at the producer level. And as a result, I'm not quite sure what the Fed says. But again, most everything I'm seeing is suggesting that inflation isn't a problem. I've been saying this for months and months. And you know, the Fed wanted to see movement back toward its 2% target. We continue to see that. I'm not sure, you know, I get the position they're in. They want them to be cautious and so forth. But at some point, you just got to call what's happening. And we'll see if that's later this afternoon or not. But 10-year Treasury yield clearly trending below the 20, which is now below a declining 50. We had not seen a declining 50-day moving average on the 10-year Treasury yield since back in May. Now we are seeing it. So this month we've rolled over. The 20 is clearly moving down below the 50. And so far the yield has been staying below that 20. That is a very, very bearish configuration for the yields. And I think a very bullish configuration for U.S. equities. S&P 500, fourth straight day of gains. And I mean, we're closing on the high every day. So, I mean, there's been almost no weakness. If you look at a 5-day, 10-minute chart, you see a little bit of volatility in the morning where we've gone up, back down, and so forth. But when you get into the afternoon, it's just steady, boring action. And boring is what we love as bullish. You know, if you're on the bullish side, You love boring, or at least I love boring. Some folks as traders really like the crazy back and forth. You can have that as far as I'm concerned. Give me the low VIX and give me the slow, boring, but crushing moves to the upside for the bears. If you're on the bearish side and you're, watching this, and you've been watching this since the end of October, at first it was a pretty big move to the upside, but since then it's just been this steady diet of less than 1% advances that just keep adding up and adding up and adding up. It's just like torture by 1,000 needles if you're on the short side. Anyway, we finished right at the high of the day. The S&P now 46.43 on the close yesterday, getting closer and closer to my target from Market Vision 2023, where I thought the S&P would climb to 4,700 by the end of the year. We are almost there. We withstood the correction over the summertime and rallying back now, really looking about as bullish as it could look. And I'll explain that when we get to the chart of the day. But anyway, S&P 500 just continues to push to the upside. NASDAQ 100, after this correction that you can see, late October started this move to the upside. And now it's just this steady push to the upside 4 days in a row, just like the S&P 500, closing pretty much right on the highs. I'm going to do something. I'm going to pull up a stochastic reading, because the stochastic reading, before I get into it, what it does is it looks at the last 14 days and it sees where you close within that range. So if you're at the top of that range, like yesterday, we closed exactly on the high of the day. So yesterday, the stochastic reading would have been 100 because it was at the very high end of the 14-day range. The last 2 days have been basically the same. In stochastics, it's a 3-day move. It's a moving average of the last 3 days readings of stochastics. But the last 3 days have all been the same, either at 100 or very, very close to 100. So I'm going to pull up stochastics and show you something that, well, I'll tell you when we get there. Let me pull up. Usually I use false stochastics. And right now, here's your reading. So it's at 93. If we close another day, it's probably because of this third day going back. It's below the high. And so in this 14-day range, it's probably maybe a 80 reading or something like that, whereas these last two have been 100. If we have another strong day today and finish on the high, we'll see this stochastics reading go to 100. The reason I wanted to pull this up is sometimes you'll see that as you're making breakouts, like right in here, you see the stochastic level, which is lower, and then you make another breakout and stochastics drops further. And now we're making this breakout. Each of these breakout days, we've seen a stochastic reading that's even lower. I see folks try to use stochastics for negative divergences, and I think it's the biggest waste of time. First of all, if we do have a strong day today, the stochastics reading is going to be right up against 100. Stochastic is a bound oscillator. It cannot go through 100. That is the top. So if we get to 100 and the next high, we see stochastics stochastic at 96, those who you look at stochastics are going to say that's a negative divergence. Well, let me ask you a simple question. How could we not have a negative divergence? Because no matter what the market does, we cannot go above 100. So if you get a stochastic reading at 99 or 100, what is the point of calling a negative divergence? So, okay, the stochastic only got up to 97. How does it get to 101? How does it make a higher high? It can't. It physically cannot. So you have to understand these oscillators and what they're useful for and what they're not useful for. The stochastic is not at all useful with divergences. Sometimes you might look back and say, well, this one worked, this one. I'm just telling you, it doesn't make any sense. I don't care if they work or not. It makes zero sense because it's a bound oscillator and it does reach that height periodically. It will get to 100. I mean, go back to late March. Here we finished up close to the high of the 14-day period for 3 days in a row. We had stochastic, I don't know, looks like it's probably 98. I don't know. Every one of these highs as we went up for the next several months were all lower. I mean, is every one of these highs a negative divergence? You'd miss out on the whole run. I want to just talk about that. I don't usually talk too much about stochastics. I used to have stochastic on my default chart. I used to use it a lot, and I just found that it wasn't as useful. I would always use it in concert with the RSI. If both of them were overbought, then I would consider the market overbought. That kind of a thing is what I would use it for. But I just found that other things like the AD line, the PPO, and so forth, or even the RSI, I prefer over stochastic. But I wanted to mention that. Moving on to the IWM, still in this nice uptrend, nothing wrong here. In a bullish, like a bull flag, had a nice move up, trading up here. Looks to me like it wants to go higher technically. Historically, we've got to at least recognize that this is a rough week. It's option expiration Friday, which normally the market struggles when it rallies into option expiration week. Usually the end of option expiration week and even into the first half of the week following option expiration can be difficult. And there's a lot of historical precedence for that. So, I mean, you can take my word for it, or you can just do the research. So we want to be careful, even though we know we're in a nice uptrend. And what that means for me, as I've said here in recent days, is just no leverage. Ride the market up with the ETFs, but just understand, I mean, with the Fed meeting today, volatility generally picks up after, imagine if the Fed says something about, hey, we're not done. We don't believe we're done raising rates. What if they say that today? I mean, the markets, 10-year treasury yield's been going down, 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 straight down. The market's been going straight up. If all of a sudden they make a statement, something like that, or just strike a little bit more fear, we could see a pullback. And if we see a pullback, it probably is going to hurt a lot if you're in those leveraged ETFs or if you're adding to those leveraged ETFs. Listen, you can do whatever you want. I'm not a registered investment advisor, but when I look at the market, I try to evaluate the risk. How much risk do I want to take based on what I'm seeing with all my signals? And, we may go straight up for the next week, but my signals are saying the risks are elevated. And so how do you approach that when you're in a bullish market and it seems to go up every day, but you're starting to see increasing risks? Well, for me, I just take out some of the risk components of my portfolio, leverage, which would include options. I don't think it's worth being in options on the long side, knowing that max pain on the QQQ is 10% below where we closed yesterday, and probably going to be 11% or 10.5% when we get the opening, through the opening bell, which will be in about 13 minutes. So anyway, I just think you need to be careful here. Doesn't mean you can't stick with your long positions. I'm pretty much sticking with long in my retirement. I'm fully invested. In my trading account, I've pulled back a little bit, just being a little bit less aggressive. And if I go up, I'm still fine. If it comes back down, great. Go back to the 20-day, because that's when I'll consider going back into the leverage. But that's kind of how I'm approaching the market. And, I mentioned yesterday, and I'll mention it again, I get comments sometimes saying, well, you're bullish and you're bearish. You can't be both. Pick one. Well, I'm bullish. I'm bullish the stock market. I've been bullish all year. But I recognize when the market is primed for maybe some consolidation or a pullback. Long-term trader doesn't, or long-term investor, that doesn't matter. Short-term trader, trying to keep as much as your capital is kind of a big deal. So yeah, I want to know what could happen in the short term and adjust my portfolio accordingly. Transports continued to move off yesterday's advance. We did see a new high yesterday. We pulled back later in the day, and we did finish in the lower half of the trading range for the day. But still, this overall pattern remains very bullish. Still like the transports here. I wanted to mention volatility. I mean, since the end of October, and anytime the VIX gets into that 20 or above range, I recognize it. I respect it, because I know what happens to the stock market when the VIX is above 20. I know historically what happens, and it's not good. When it's coming down from 20, it's doing great. But the problem is when it gets above 20, going from, on the VIX, going from, say, 12 to 18, which is a 50% move up, is not the same as going from 20 to 30. which is a 50% move up. When the VIX is high and it starts accelerating, the losses begin to accelerate significantly. So the VIX, as long as it's under 20, even if it were to start rising a little bit here, go back up 15, 16, whatever, I'm still fine. We're still way below that 20 threshold, which is good. That means that the market makers are expecting volatility to remain relatively low. And the way you see that is in their pricing of options, namely the short-term S&P 500 options. So anytime the VIX is low, market makers are telling us, giving us a big hint that they don't see huge movement, huge volatility in the market. And it's not until you get up above that 1920 area that really that's when we start to see a lot of selling kick in the market. So anyway, take that for what it's worth. I did a study through 2013. If you go back to my Trading Places blog, you can go back maybe about 3 or 4 articles, and it'll be an article titled, the odds of a crash are 0 according to this indicator or something along those lines. But check that out. It's really I was fascinated doing the study, and I just did it, 2 or 3 weeks ago. But when you get down into this area, the stock market, you see what's been happening since we've been below 13. You've seen the S&P 500. This is the S&P 500 since the VIX has gone below 13. Really boring action to the upside, which is, again, my favorite type of market. Unless that VIX makes some kind of a sudden surge and at least moves back up through 13, 14, this is a great low volatility environment for stocks. All right, let's move on to the chart of the day. So if you go over to EarningsBeats, and I talked a little bit earlier about historical patterns. If you haven't checked it out, we actually have, it's not on here, but we can go back into any of my articles, and you'll see at the bottom of most of my articles a sign up where you can just click on the link and type in your name and email address, and we'll get a 7-page PDF out to you that explains what's going on historically anyway with the S&P 500, when it tends to move up, when it tends to move down, when you need to be careful throughout the calendar month, when you get more of an everything is good, all is clear signal. You really need to understand how all that works, but you can find that link in many of my recent articles. So check that out. Also want to mention, for those who are members of EarningsBeats, in about 38 minutes, we will open our live trading room where I go through, talk about the way I approach the market, how you use our system at EarningsBeats to find some really high quality trades. Again, right now being a little bit more on the cautious side, I might tend to avoid some of the stocks that have made these big, crazy moves to the upside with options expiration just a couple of days away. But there might be some others in defensive areas, maybe in materials and energy that have been beaten down, or at least in energy, which has been so beaten down. There might be some plays where if we do see rotation, those are areas that could pick up heading into options expiration. So anyway, we'll talk about all of those types of things. If you want to attend and you're not currently a member, you can simply click on this join now, and we'll give you a 30-day free trial. 30-day free trial. You can come into today's Trading Places or live trading room, and you can come into the next 4 after this one, because you're going to be a trial member for 30 days. So you can come into 5 trading rooms. I try to make them educational, but I also try to make them, so that you can kind of understand the strategy that I use in trying to come up with high reward to low risk types of trades. So be sure to check that out. If you're new to the channel here, or, to YouTube, you just found us, or you have, just started listening recently and you're not ready to take any kind of a plunge, you just want to learn about the market, subscribe to our EarningsBeats Digest. This is a 3 times a week newsletter. It's free, completely free, no credit card. You can unsubscribe at any time. To get your subscription started, all it takes is a name, email address, hit that subscribe button, and you're in. Today's chart of the day, I'll go over what we sent out to our members, or to the EarningsBeats Digest subscribers. It was a chart of the S&P 500 showing this breakout, but also showing how I like to evaluate a breakout. Anytime the S&P 500 makes a big breakout, and I think going through 4,600 qualifies, I want to see what the leadership is. You know, the big Wall Street firms and all of their wealthy clients, institutional clients, wealthy individual clients, they control a lot of the action. They've got a ton of money because at these big financial firms, it's not just their clients' money, it's also them trading as market makers. And so there is a lot of influence from the big Wall Street firms as to where the money goes. And so following charts can help you almost like reading a book. The charts tell us a story. And one of the stories I like to read very often is the story of rotation among sectors. And so below this S&P 500 chart where we're breaking out, I wanted to show you our 5 aggressive groups relative to the S&P 500. The 5 aggressive groups are technology, the XLK, consumer discretionary, XLY, communication services, which is the XLC, industrials, XLI, and financials, XLF. Now, I would say tier 1, which is what I consider to be the most influential sectors, are going to be the XLK, XLY, XLC, technology, discretionary, communication services. And so I've got them kind of in the order that I like to follow them. Technology is my number one. Why? Because it's 28% of the S&P 500. So if you're evaluating the S&P 500, probably would be a good idea to see if that 28% is leading the market higher or if it's actually holding the market back. In this case, the XLK is broken out relative to the S&P 500. We're seeing leadership from technology. That is a massive check mark in the bulls column because technology stocks, they don't pay dividends. Income, those looking for income are not buying technology stocks. Few of them pay dividends, and the ones that do pay relatively low dividends, very small dividend yields like the Microsofts, the Apples, maybe they're around 1% or less. Instead, technology is most of this group is based on future growth. So when we're seeing, hold on one second. When we're seeing this group breaking out, it's telling us that the market is expecting either the future earnings to go up or it's expecting interest rates to come down or a combination of both. When we saw both back in 2020, after the pandemic hit, you remember the year that technology had? Because many of the big companies in technology were able to actually use the pandemic as leverage to drive higher profits. At the same time, interest rates were falling through the floor. That combination sent the stock market soaring and also set up the cyclical bear market of 2022. Anyway, I digress there. But I always like to see technology performing well because it does have such a big influence on the S&P 500. Can't really knock this, right? I mean, we struggled a little bit during the correction, although August was the low relative strength. By September, S&P 500 kept dropping September and October, right? Right here. New low, new low. Guess what was happening? Money was rotating into technology. Anybody on CNBC telling you that? The big financial firms coming on and saying, hey, we see this as a great opportunity. The market's going to go higher. We'd recommend buying technology names. You might have saw it periodically, but for the most part, they were focusing on new low. It's a new low. It's a new low. We're going back to those 2022 lows, ignoring the fact that money was rotating back into the most aggressive area in the market. Anyway, we've just continued moving higher. This is a major signal that this rally right here is sustainable. I'm not talking about for the week. I mean, maybe we go down the short term. I'm talking about into the latter part of this year and into the beginning of next year. This is telling me that this move to the upside is not over. You go down to the XLY. Okay, the 3 months during the correction, this one did come down. But look, since the end of November or end of October, leading the S&P to the upside. Communication services has been moving lower, but I have been warning that this is a group that doesn't like the end of the year. This is a group that doesn't do well in December. And I don't remember, I think in November it does okay, but December, it doesn't like the month of December, and it's going down on a relative basis again. But that money is rotating into discretionary. It's rotating into technology. It's rotating into financials finally. We bottomed the beginning part, or excuse me, industrials. We bottomed on a relative basis on the industrials back the beginning of November, and we've been rallying since. Look at financials. Since the end of October, since this rally started, financials leading. So all of the aggressive groups outside of communication services are supporting this rally. That's where the money is going. If I pulled up the other 6 sectors here, you would see that the defensive groups are all going down. Money is rotating into offense and it's staying away from defense. That is not what happens right before a big drop in the market. So those who are saying we are still in a bear market, we're going to keep going lower and we're going to go back and retest those lows, we're going to take out those lows from 2022. All I can say is I wish you a lot of luck, because that's not the story I'm reading in this book. All right, that is it for me. I appreciate everybody tuning in. I'm going to go ahead and show you real quick what's going on with the market. Right now, just opened, Dow down 15, S&P up 2, NASDAQ up 35. Small caps up a little bit. VIX still hovering. It's down, or it's up today, but still down in the 12s, low 12s. Only thing I would say is just in the short term, there's more risk. Big picture, long term, like I just showed you on that chart of the day, I couldn't be much more bullish. And when we talk about at Market Vision 2024, first Saturday in September, more information to come, I will evaluate what I'm seeing at that time. It might be different. If you look back at 2021, in the month of December, everything changed. I mean, consumer discretionary was flat for the month of December 2021. You think, okay, well, that's not too bad. Consumer staples were up 10%. Money was rotating heavily towards defense. And historically, we see a little bit of that in the month of December, but not to that extent. So what's going to happen during the rest of December? Let's see the rest of the story. The 2023 book has not yet been fully written. We've got another few weeks to go. Let's see what happens. And then mark your calendars and plan to join me on that Saturday, first Saturday in January. It'll be our 5th annual Market Vision event, the last 4. I mean, I'm not one to pat myself on the back very often, but I'll tell you, the forecasts I've given the last 4 years have been nearly spot on. And based on what I'm seeing right now, I have a pretty good sense of what I think is going to happen in 2024. We'll see as we get closer to that date, but mark your calendar. First Saturday, I think it's January 6th. But anyway, mark that on your calendar. We'll talk about it more in upcoming days. Anyway, that's it for me. I appreciate everybody tuning in. For those of you that are watching here on the YouTube stream, thank you so much. Really appreciate it. And for those who are going to be watching later on the recording, we could really use some help here. Hit the like button, subscribe to our channel. That'll keep you up to date on all the things happening at EarningsBeats. And we certainly would appreciate that support. Have a great day, everybody. Happy trading. And I'll see those EarningsBeats members, those of you out there, in about 25 minutes or so. Happy trading.